hope you are doing good. Welcome back to our discussion on advanced financial reporting. And what we are studying today is preparation of consolidated cash flow statements for group accounts. When presenting group cash flow statements, remember that you have to observe International Accounting Standard number 7, that is IAS 7. And we say that there are two methods that we usually use. One is a direct method and the other is indirect method. In this question, we are going to apply indirect method, whereby we show adjustments for profit, and then that will be appearing as operating activities, and then after that, the other part will be comprising of investing activities, which involves the acquisition and disposal of non-current assets, and then the last part will be financing activities, which is to do with items like equity and long-term borrowings. We know the reason why we should do the cash flow statements is that there is a difference between cash and profit, because when you talk of profit, we don't really mean the cash available. The profit that you make does not necessarily mean that is the cash which you have. A business may be making profit, but on the other side, there is no cash. So we need to reconcile the reported profit with the cash and cash equivalents that we have in the bank. So as I told you, is that when preparing the cash flow statements, the first thing that you do is to get your profit before tax, and that profit before tax, you add back any expense which was deducted but did not involve actual cash movement. An example is depreciation or impairment. Depreciation, we usually less depreciation when calculating profit, but it does not involve actual cash movement. So you have to add back that depreciation. The same with impairment. We less impairment, but it does not involve actual cash movement. So we have to add back things like impairment. Now, the other adjustment that you can do here is the gain in terms of the disposal of non-current assets. When you dispose a non-current asset, there is a gain, there is a reported gain, which is added on the profit, but that is not an actual cash inflow. So such an item should be deducted because it has been added back. So that is what you'll be doing here, including misplaced items like share of profit from the associates. If you receive a profit share from the associate and that amount has been accounted for under the operating activities, then obviously we know what is coming from associates is not an operating activity. That should be an investing activity, and therefore it has to be accounted for accordingly. So we'll be adjusting our profit here. We adjust this reported profit here appropriately, and then after that we show working capital changes. Now, working capital means current assets and current liabilities. Mostly, you'll be dealing with inventory, which is also called stock, debtors, also known as receivables, and then creditors, also known as payables. Now, I advise that you'll be preparing a T account, that is having in mind that assets have a debit balance. Increase in assets, you debit, and decrease in assets, you credit. Liabilities have credit balance. Increase in liabilities, you credit, and decrease in liabilities, you debit. So if it is inventory, you'll be given opening balance, the closing balance. Therefore, bring down the balances appropriately. If for the stock, the difference is on the credit side, it means that stock decreased. And when stock decreased, what does it imply? We have sold more stock, therefore cash is coming in, there is money in. So that will be a plus. If it is the other way around, if you prepare your T account for the inventory or for the assets, specifically here for the stock, and you find that the balancing figure is on the debit side, it means that we purchased more stock. And if you are purchasing more stock, what does it mean? It means that money is moving out. So that figure will be a minus in our case here. The opposite for liabilities. If liabilities have increased, it means that we are receiving more money in terms of loans. Therefore, that will be a plus. If liabilities, that is, if payables are decreasing, it means we are paying for that particular liability, and therefore money is moving out. So I'll show you what I mean by the working capital changes, but be conversant with how to prepare the T accounts for assets and liabilities. Then after that, you'll be lessing tax there and interest. See this interest there, most of the time it is misplaced. It is subtracted before this particular tax here, and therefore it has to be deducted down here. You'll be adding it back and then you are lessing it down there. Then you sum up all these figures, you'll be getting net cash flow. Net cash flow from operating activities. Then adjust the investing activities accordingly. Investing activities are to do with non-current assets, and these are items like PPE, property, plant, and equipment. Be considering if you purchase an asset, money is moving out, you'll be lessing that. If you are purchasing an asset, you'll be lessing that particular figure. If you are disposing that asset, money is coming in, and you'll be saying plus. In other words, you are concerned with the cash flow statements, you are concerned with the actual cash coming in and going out. So once you have worked out the investing activities, sum up all those figures, and then the financing activities, you do the same. Then finally, sum up the net cash flow from operating activities plus net cash inflow from investing activities plus what is coming from financing activities. You get the net changes in cash and cash equivalents. Then sum up the three figures, and then you plus. If you sum up the operating activities figure plus investing activities figure plus financing activities figure, you get net changes in cash and cash equivalents. Then you plus a cash and cash equivalents brought forward, which is given, and then you see your answer should be cash and cash equivalents carried down. Okay, let's continue. Now, one important thing that you should note as far as this question is concerned is that you always be provided with the statement of financial position, the opening balances, and the closing balances. 2 years will be provided for statement of financial position. The reason why you are given with the closing balances for last year is to enable you to open the current year. Now, the other item that will be provided with is the profit and loss account, or a statement of comprehensive income will be provided with that information for 1 year, and that will be containing profits, things like expenses, things like revenue. Now, another important thing that you should know when consolidating group the group cash flow statements is you identify whether there was disposal of a group member or there was acquisition of a group member. That's important thing. Now, I think now we should just continue straight away with our question, our discussion. Now, what we're taking today, as I mentioned before, is advanced financial reporting, and we are taking a KASNEB paper which is November 2019, question 4. November 2019, question 4 is a KASNEB paper, the Kenya Accountants and Secretaries National Examination Board. Now, we read it from the paper, and I believe you have that paper with you, and then I show you the solution. The solution appears here. However, I'll present this paper to you. You look at that question, then I will show you solution, and then as I show you the solution, I'll also be elaborating and explaining each point as it appears here and as it appears elsewhere. Now let's go through this question together. I want to read this question. We read this question. Now the question starts on that side. We are told this question for the following financial statements relate to Makongeni Group for the year ended that 1st October 2019. Consolidated statement of financial position is at that 1st October. You are given 2 years, 2018 and 2019. I've told you that you must be presented with two years, that is with respect to statement of financial position, to enable you to bring down the balances. So the assets are there, non-current assets, property, plant and equipment, goodwill, and investment in associates. In both cases, you have been given the balances for 2018 and the balances for 2019. So the balances that you have for 2018 will be your balance brought forward in the year 2019. That's important. Now we move to the next page. We move to the next page where the statement of financial position continues. Okay, you can see you are given current assets for 2018 and 2019. You can see that you have current assets, you have inventories. Inventories is a stock. Trade receivables means debtors, short-term investments, cash and bank balances. Then total assets are given. Equity and liabilities, we have equity, ordinary share capital, revaluation surplus, retained earnings, non-controlling interest, then total equity. Then we have non-current liabilities, bank loans, then deferred tax. Current liabilities, trade payables, and current tax. Then we have total equity and liabilities. So you can see that, as I have told you, you'll be presented with a statement of financial position for 2 years, showing assets, liabilities, and equity for last year and this year. The reason is to enable you to bring down the balances accordingly. That's the reason. So you have seen the statement of financial position as presented. As I have told you somewhere here, you'll be dealing with different assets. So you should be having balance brought forward from last year and the balance carried down, the closing balance for that particular year. That is quite important. So that is the purpose of being presented with the statement of financial position with two balances for last year and this year. The other portion that you'll be provided with is A statement of profit and loss or income statement, which will be containing profits, expenses, revenue, and such other items. But that one will be only dealing with 1 year, not 2 years, because we are doing a cash flow statement for 1 year. We are not taking cash flow statement for 2 years. Cash flow statement is only for that particular year. But the reason why you are provided with a statement of financial position for 2 years is to enable you to bring down the balances accordingly. For income statement or profit and loss account, you are always provided with 1 year, the year for which we are preparing the cash flow statement for. Now, next thing, let me show you how my profit and loss account looks like. Now, just check what I have. We have consolidated, you have Makongeni Group, consolidated statement of comprehensive income for the year ended at 1st October 2019. You have revenue, operating expenses. If you less that, you are left with profit from operations, gain on disposal of subsidiary, finance costs, share of profit of associate, profit before tax, income tax expense, profit after tax for the year. Then other comprehensive income, revaluation gain on property, other comprehensive income of associate, total comprehensive income, then profit for the year attributable to owners of the parent and NCI. Then you have total comprehensive income for the year attributable to owners of the parent and NCI. Okay, with that, the next part now, we go to the additional information. Now, most of the times, all the examinations in financial reporting, you find there a lot of work to be done with what is contained in the additional information. In what you find here is that, as I have mentioned earlier, always establish whether there were certain group members which were acquired within the course of the year, or whether there were some group members which were disposed within the course of the year. That has an effect, because if you are sure, you are told that there was acquisition of a group member, obviously, when we acquired that group member, we may have acquired some assets and liabilities from that group member. And again, when we acquire a group member, there is a goodwill. We have to establish that goodwill, and we know how to calculate goodwill. We take the purchase consideration minus net identifiable assets, the net identifiable assets, the fair value of the net identifiable assets. So whenever there is a acquisition of a group member, within that particular year, establish the goodwill, and then again, there can be disposal of a group member. In that case, establish the goodwill which is being disposed in that case, and also some assets and liabilities being maybe disposed within the same year from that particular group member. That becomes important point. Now, let's take the additional information, whereby we go to additional information number 1, and what I am told is during the year, Makongeni Limited acquired 80% of the ordinary share capital of Razaka Limited, paying a cash consideration of shilling 6,000 million. Non-controlling interest holding was measured at its fair value of shillings 1360 million at the date of acquisition. Okay, that additional information continues on the other side, and we are told that the fair values of the net assets of Razaka Limited as at the date of acquisition comprised the following: property, plant and equipment, inventories, trade receivables, cash and cash equivalents, trade payables, and tax payable. Okay, so that means an acquisition with this parent called McConken Limited has acquired a subsidiary known as Razaka. So in that case, obviously calculate the goodwill arising out of that acquisition. And then consider the other assets which have been acquired. So that is acquisition. That is acquisition of a parent. I'll show you how we'll be accounting for that point. For number 2, we are told that during the year, Makongen Limited also disposed of its entire 60% ordinary shareholding in Salama Limited. The subsidiary had been acquired several years ago for a cash consideration of shillings 2,400 million. The non-controlling interest holding was measured at its fair value of shillings 12.8 million as at the date of acquisition, and the fair value of Salama Limited's net assets was shillings 29.20 million. Goodwill on acquisition of Salama Limited had not suffered any impairment. At the date of disposal, the net assets of Salama Limited had carrying values in the consolidated statement of financial position as set out below. Property, plant and equipment 2,900, inventories 660, trade receivables 480, cash and cash equivalents 200, trade payables 320. Additional, so that is to do with disposal. We disposed a subsidiary, and we are given the fair values and consideration, fair value, net assets value, and other information there. We move to 3 and 4 now. Check number 3. We are told the short-term investments are readily convertible into known amounts of cash, and there is an insignificant risk of their fair value changing. Number 4, depreciation of shillings 1540 million was charged during the year. Plant with a carrying amount of shillings 1,000 million was sold for shillings 1,100 million. The gain on disposal was recognized in the profit. Some properties were revalued during the year, resulting in revaluation gain of shillings 800 million being reported. Ignore deferred tax on revaluation of property, plant and equipment. Required consolidated statement of cash flows for the McConken Group for the year ended at 1st October 2019 using the indirect method. In accordance with the National Accounting Standard 7, IA7 statements of cash flows. So that is what we have. That is your question. That is your question. Okay. Now, I've shown you how that question will look like. The solution will be, it should be as it appears on the board. Now, what I do is that I'll show you all my workings, the workings of each item here, and then I'll show you how we arrived at our figures here. So I believe you have read the question. Please take time to read that question and try to understand the question so that as I show you my workings and my solutions, you'll be able to understand more faster. I even advise you to first take the question, do the question yourself, and then I show you the solution you compare. Now again, if you need textbooks, a textbook for advanced financial reporting, you can just call me. My number is I'll present later on, 0727 87 10 93. You can get, we have published study text materials for financial reporting, advanced financial reporting, and CPA books. So you can call us for any assistance. Again, we request you to subscribe to our YouTube so that you can continue getting the updates of these uploads for the purpose of your examination. Okay, let me show you. I've shown you the question, and I believe you have that past paper with you. Look at that past paper. That is November 2019, question 4, Advanced Financial Reporting. And then I show you our solution or our workings. Now, I start by showing you the workings, and then I show you the solution step by step. Each step, I'll be showing you a solution. Now, I start with we have 11 workings. Show your workings in the examination. We have 11 workings. I just present to you briefly, and then I discuss them with you. So you can look at our workings. We have 11 workings for that question. Now, working number one is to do with goodwill arising on acquisition of Razaka Limited. So we are told that Makongeni Limited acquired Razaka Limited. So when Razaka Limited was acquired, what is the total goodwill? Remember the methods that we use to calculate goodwill. We have partial provision method as well as and then full provision method. In this case, we are using full provision method. Okay, that's goodwill arising on acquisition of Razaka Limited. You can see we have the purchase consideration that you find in additional information number 1. Our working number 2, you will be dealing with goodwill on acquisition. Goodwill on acquisition of Salama Limited. That will be your working number 2. Our working number 3 will be gain or the disposal of subsidiary. Now that figure was given in the income statement. We are given gain on disposal of the subsidiary. The figure was shillings 400 million. But these workings we are just trying to show you in case the figure had not been given, how you could have calculated that. Okay, that is working number 3. Your working number 4 is to do with goodwill. Working number 4 is to do with goodwill. Working number 4 is goodwill. You bring down the balances accordingly. Goodwill, bring down the balances accordingly. Working number 5 is about PP, bring down the balances accordingly. Investment in associates will be working number 6. Working number 7 will be tax paid. Number 8, working number 8 will be for NCI. 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 And working number 9 will be for working number 9, 10, and 11 will be for stock, debtors, and payables. You can see our stock, we brought down the balances accordingly. On the debit side, any stock which was acquired when we acquired Razaka, and on the credit side, any stock that was disposed when we disposed them, the subsidiary. Debtors is working number 10, and payables is working number 11. So in that question, we'll go through we will go through 11 workings, and finally, what you will expect is a cash flow statement, consolidated cash flow statement, which will be something like that. You can see operating activities just as it is on the board. Then working capital changes, investing activities, will be showing the figure, right? And the last part will be financing activities. The financing activities, you find those figures as they appear there. Okay, you can allow me now to take you through each point as we have explained. Now we have said that cash flow statements, when you're presenting the cash flow statements, in this case we are using the direct method. So what you do is, with the indirect method, you adjust the profit. When calculating the profit, we say that we usually use the accrual basis. Cash may either have been received or not. We anticipate cash to be received. We record it. We anticipate expenses to be incurred. We record them. So most of these figures that we have, when calculating the profit, they do not actually involve actual cash movement, and for that reason, we are supposed to adjust them accordingly so that we may reflect the true cash position that we have in the bank as you compare the opening balances of the cash with the closing balances of the cash. So that is the reason as to why you have to compare the opening balance for the cash and cash equivalents with the closing balances of the cash and cash equivalents. You reconcile the two so that you are able to explain to the shareholders or the owners of the business what brought up the difference between the opening balance of the cash and the closing balance of the cash. As we will illustrate here, you can see that we started with profit before tax. A profit before tax is 4460. 4460, as I've told you, will be provided with a statement of financial position for 2 years and the statement of comprehensive income or profit and loss statement. You go to the consolidated statement of comprehensive income for that company, and then you identify the profit before tax. The profit before tax, which is provided, you can see profit before tax 4460. Profit before tax profit before tax 4460. Then look at all the figures above that 4460 and establish which figures should be adjusted, which figures do not involve actual cash movement. I can see gain on disposal of subsidiary 400. I can see finance cost 140. Share of profit of associate 460. Now those three figures which you see there, they are coming before the profit before tax. So in arriving at profit before tax, the gain on disposal of subsidiary was earned, finance cost was deducted, share of profit of associate was earned. So how do we account for those figures? Now, the first you find is the first thing that you find in these workings is so once you have established profit before tax, even though the figures that are mentioned there, again, they have to be accounted for, like share of associate profit. This figure was earned in arriving at the profit. Share of associate 460, but it is not an operating activity. If you are receiving shares from the associate, then that figure is not an operating activity. that is an investing activity. So that's why it has to be deducted, because it is a misplaced item and it has to be taken in the right side. So it has to be deducted. Now, the other thing that you find is the gain or the disposal. You dispose an asset, we make a gain or disposal if the carrying amount is less than the cash proceeds. If the cash proceeds is more than the carrying amount or the net book value, then there is a gain. The opposite means there is a loss. In this case, you disposed an asset and you made a gain. It was not an asset, but it was a subsidiary which we disposed. We disposed a subsidiary and we made a profit of 400. But that profit does not involve actual cash movement. So it was earned in arriving at the profit. Therefore, that is why you find here it has been deducted. Now, we start with note number 4, depreciation. If you read point number 4, we have been told that depreciation of shillings 1540, and that's the point that I just want you to note. That's the point that I want you to note. That is point number 4. Read it. Point number 4. Depreciation of shillings 1540 million was charged during the year. Depreciation of shillings 1540 was charged during the year. That's a point that I want you to note. So for that particular year, depreciation was 1540. So in arriving at the profit for that particular year, we deducted depreciation of 1540. But depreciation does not involve actual cash movement. Therefore, it has to be deducted, so we add it back. Next, impairment. The next item you find is impairment of goodwill. Now look at working number 4. Working number 4 is where you find impairment of goodwill. Working number 4. Now, in your working number 4, first we established the goodwill balances. Now remember again, your working number 1, and working number 2, they are also important. I remind you about the goodwill in point number 1, the workings in number 1. Now let me explain your working number 1. A working number 1, which is originating from additional information number 1. What had you been told? If you look at additional information number 1, during the year, Makongeni Limited acquired 80% of the ordinary share capital of Razaka Limited, paying a cash consideration of shillings 6,000 million. The non-controlling interest holding was measured at its fair value of shillings 1360 million at the date of acquisition. Then, the next thing that you are told, the fair values of the net assets of Razaka Limited as at the date of acquisition comprise the following. The figures are given there, and the totals are 5960. Now, because this was acquisition, remember this was a subsidiary, because we acquired 80%. The remaining goes to NCI, the NCI. Now, what we will do is that you will take the purchase consideration plus fair value of NCI. What is the purchase consideration? How much did we spend to acquire that? Is this 6,000 million here? This is the purchase consideration, and The NCI, you are given 1360. The NCI was measured at its fair value. So usually, when you are calculating goodwill, take the fair value of the NCI plus the purchase consideration. So in that case, you'll be taking 6,000 plus 1360. Then you minus net assets acquired. You take the purchase consideration for them, which was paid by the parent, 6,000 plus fair value of NCI, 1360. Then you less the net assets acquired. The net assets acquired is, you can see you are told the fair values of the net assets of Razaka Limited as at the date of acquisition comprised of the following: PP, inventory, trade receivables, cash and cash equivalents, trade payables, and tax payable. 5960. So 5960 is the net assets acquired. So what you do is that you sum up 6,000 and 1360 and you less 5690, you get 1400. Now you may wish to know, because we are using full consolidation method of calculating goodwill, you may wish to know how much of that goodwill goes to the NCI and what goes to the parent. You can see what I've told you. Purchase consideration, we spent 6,000 to acquire Razaka. Then fair value of one NCI was 1360. You less the net assets acquired, 5960. The goodwill is 1400. So out of this 1400, because that is the figure that we usually consolidate, but you may wish to know, out of that, what goes to NCI and what goes to the parent. So goodwill to the NCI, you take that 1360, which is the fair value of NCI, minus, we acquired 5960 of the fair value, the net identifiable assets. The fair value of the identifiable net assets for Razaka was 5960. That's given. So 20% of that went to the NCI. So what is the goodwill in the NCI? You take the fair value of the NCI, 1360, minus that proportion which they acquired in that subsidiary. So 1360 minus 5960 times 20% is 168. Parent's goodwill, the parent paid 6,000, you minus, proportion of net assets was 5960 times 80%. Because we acquired 80%. Remember, 80% plus 20% is 100%. So the goodwill in the parent is 1232. The total gives you 1400, the same. So we have calculated goodwill and we have gotten 1400, and we want to apportion that goodwill on the parent and the NCI. Okay, the other item for the goodwill that I want to show you before I continue analyzing my analysis on the other side is to do with additional information. So that number one is explaining what happened when we acquired Razaka Limited. How much goodwill arose when we acquired Razaka Limited. Now, point number two is the other part which I want to illustrate to you. And we are told that point number two, during the year, Makongeni Limited also disposed of its entire 60% of ordinary shareholding in Salama Limited. The subsidiary had been acquired several years ago for a cash consideration of shillings 2,400 million. The non-controlling interest holding was measured at its fair value of shillings 1280 as at the date of acquisition, and the fair value of Salama Limited's net assets was shillings 20 million. Goodwill on acquisition of Salama Limited had not suffered any impairment. At the date of our disposal, the net assets of Salama Limited and carrying values in the consolidated statement of financial position as set out below. You're able to see that PPE, inventory, trade receivables, cash and cash equivalents, trade payables. Okay, so out of that, if you are able to read that, I will show you how we go about how much goodwill arose. So the first thing we calculate is the goodwill that arose on acquisition of Salama Limited. So we acquired Salama several years ago. So how much goodwill arose? So that when we dispose Salama Limited, we remove that goodwill from our books. So purchase consideration, 2,400. If you look at the purchase consideration from our question, we are doing working number 2, goodwill on acquisition of Salama Limited. The purchase consideration was 2,400. Fair value of NCI, 1280. Sum them together. You less than net assets acquired was 2920. So the total goodwill is 760. Just as we have done with working number 1, you may wish to know the NCI, what the goodwill that goes to the NCI, and the goodwill that goes to the parent. So you take the fair value of the NCI, which is 1280, minus 40%. Remember, we acquired 60%. We had acquired 60% of Salama. The remaining 40 goes to NCI. So 40% of the net identifiable assets as at the date of acquisition was 2920. So 1280 minus 40% of 2920, 112. Then parent's goodwill, 2400 was the purchase consideration. 2400 you minus 60% of 2920, you get 648. So total goodwill comes back again to 760. So that is working number 2. How we have calculated the goodwill that arose when we acquired Salama Limited many years ago. So what we have done in working number 2, we have taken the purchase consideration. Now this 2400 is a purchase consideration. 2400. Substantially, you are told, look at where my figure is. That 2400 million is a purchase consideration which we spent to acquire that particular subsidiary. NCI 1280. So you are getting 2400 plus 1280, and then you're taking 2400 plus 1280, you got that 680, you minus net assets acquired. The net assets acquired, you are given that 9, you are given not that 9 but 29, you are told is 29, you are told as at the date of acquisition, the fair value of Salama Limited's net assets was 2920. That 2920 there. 2920 is what you'll be lessing. So once you less that, what you get is goodwill. And then you can try to establish that goodwill. How do we share it? What goes to NCI? And what goes to the parent? Okay, that is it. Now, for working number 3, I've said that for working number 3, we have shown some working there just for the purpose of proving the amount when we disposed the subsidiary. Did we make a gain or a loss? So, sometimes you may be required to calculate whether you made a gain or a loss. Sometimes you may be required to calculate whether you made a gain or a loss. But in this question, you are being told when we are being given that particular figure, actually, that is the 400 has been given in the income statement, that is gain on disposal. You can see that gain on disposal there. Gain on disposal in the income statement, the 400. Gain on disposal of the subsidiary. So we made a gain of 400. However, I've tried to show you if the figure is not given, the format that you follow. You can follow that format, and after following that format there, we have proved our figure. Now we continue on the other side. So I'm trying to explain how we are arriving at this figure. So we have seen the impairment. We were explaining about the impairment of goodwill. The impairment of goodwill. So how was goodwill impaired? How did we arrive at 320? That is our working number 4. So I was referring you to working number 4. Working number 4, why was our impairment 320? How did we arrive at that? So the first thing that you do is to bring down the balances accordingly. Goodwill is an asset, so the balance brought forward will be on the debit side, and the balance carried down will be on the credit side. You go to the statement of financial position, look at your goodwill where the question starts. Item number 2. You can see goodwill 2480, is that no? 7477.20. Look at goodwill, opening balance, balance brought forward, and the balance carried down. So you just need to bring down those balances accordingly. So goodwill, what we are doing, balance brought forward 7400. So this balance is coming from the previous year, and the closing balance is given. Then, when we acquired Rasaka, if you look at working number 1, there was goodwill of 1400. When we acquired Rasaka, so our goodwill is increasing because of that particular acquisition. So, working number 1, 1400. Now, when we disposed Salama Limited, there was goodwill worth 760, which was to be disposed of together with that particular subsidiary. So on the debit side, we have the balance brought forward, 7400. Then goodwill which we acquired when we acquired Rasaka, we have shown that in working number 1, 1400. On the credit side, when we dispose Salama Limited, then there is a disposal of 760. Balance carried down is given. The balancing figure, because it is on the credit side, is 320. 320. Now, just this should have been working number. Can you see this 366? There's a small mistake here. This 760. You find it in working number 2, not working number 1, because working number 2, in that goodwill, you are given working 1400 and 760. The goodwill, how that goodwill is arising from working number 1, we have goodwill of 1400. This is a goodwill which arose when we acquired Rasaka. It increases our goodwill account. And then working number 2, when we disposed Salama Limited, 760 goes on the credit side. So if you work out that, you are getting something like that. So the balancing figure, the 360 is the balancing figure, which means impairment. Okay, so that figure is 320. 320 is the impairment. Now the other thing you account for is finance costs. Now finance costs, this is interest. that is interest. Interest should have been deducted afterwards. So, finance cost, if you look at your income statement, you will find interest placed somewhere above the profit. The finance cost actually, this finance cost, you can see the finance cost. Finance costs, they deducted 140. Finance cost was deducted, but should not have been deducted at that point. Is a misplaced item. So it was deducted, you earn it back. Gain on disposal, for T is 400. When you dispose the substantial, we dispose the substantial, known as salama. So when we disposed that particular substantially, we made a gain. There was a profit of 400, but that does not involve actual cash movement. Look at working number number 3. Even though that figure has been given, you don't need to calculate again. Working number 3, that figure has been given in the income statement. That figure has been given. Gain on disposal of substantially. You can see 400 there. Gain on disposal of substantially 400. That figure was given. So it was entered. Gain is entered, but does not involve actual cash movement. Next is gain on disposal of PPE. Now, when we dispose the PPE, we meant again. So look at note number 4. Look at note number 4. Note number 4. Note number 4. You have been told that note number 4 is helping us to know whether we made a profit or a loss when we disposed that PPE. Note number 4 is still having depreciation. Note number 4. Depreciation was 1540. We have done depreciation. Plant with a carrying amount of 1000 was sold for 1100. So if the carrying amount means net book value, if the net book value is 1000 and we are selling that asset at 1100, then the difference means what? We have a profit, we have a gain. So 1100 minus 1000 is a gain of 1100. Now remember, what you receive, the actual cash that you receive goes to the investing activities, because investing activities deals with acquisition and disposal of non-current assets. So that cash which you receive, that is why when you come to the investing activities, you find disposal of PPE, note number 4, 1100. That cash that you actually received should be accounted for here under the investment, because that is actually the cash that you receive. But for the purpose of profit, you ask yourself, did you make a profit or a loss? In this case, there was a profit because the net book value or the carrying amount of this asset was 1000, but we are selling it at 11. So the difference is a gain. So that gain was entered when calculating this profit. But that does not actually involve actual cash movement. A profit is not an actual cash movement. So we have to less it here. The 100 was deducted. 100 was deducted. The total figure that we received was entered under the investment activities. Then share of associate profit. If you share profit from the associate, then that is not an investing activity. You are given in the profit and loss account, that figure was given Gain, that is a share of profit of associate was 460, 460. In arriving at the profit, which is above there, you see share of profit of associate, share of profit of associate, 460. That 460 was entered when calculating that profit which you have there. But that is a misplacement. That's a misplaced item. It was entered. It should be deducted. Share of associate from the associate. It's not operating activity. That should have gone to investing activities. So you sum up these figures, the profit before tax for 460 minus 1540 plus 320 plus 140 minus 400, gain or disposal of PP, you minus 100, share of profit minus 460, you get 500. Next is working capital changes. Working capital changes. Now here, working capital changes is to do with non-current assets and liabilities. Now, remind yourself about how to prepare the T accounts. Now, these three, I think I should not waste much time there. Not necessarily wasting time, but spending more time. I think that sounds more professional. Spending more time. Now, for the stock, if you go to the income statement, you find balance brought forward 1760 and the balance carried down 1880. What increased our stocks? When we acquired Rasaka, you find additional information number, I think 1. When we acquired Rasaka, there was a stock of 600, so our stock increased. Then when we disposed Salama, there was a stock of 660. So our stocks decreased by 660. The balancing figure will be 200. So 200 is on the debit side. 200 is on the debit side. So if the balancing figure for the stock is on the debit side, it means the stock increased by 200. The stock increased by 200. Stock increasing means we are paying for it. So money is moving out. Money is moving out so that we may purchase that stock. So that is why here we are saying you minus 200. You minus 200. Trade receivables is working number 10. Now this one is simple. The receivables are also known as debtors. You just go to the income statement. That is statement of financial position for the 2 years given in the question. You find balance brought forward for receivables, that is coming from the previous year, 1320. The closing balance is 1560. Now, when we acquired Rasaka, in the additional information number 1, from the Rasaka, there was debtors or receivables worth 960. You see, we are the ones acquiring those debtors. So they are increasing our debtors. So on the debit side, you'll be having 1320, which is the opening balance from the previous year, and 960, the figure from Rasaka, which we acquired. What is reducing our debtors? When we disposed Salama, additional information number 1, there was a receivables worth 480. And the balancing figure you can see, if you compare what is on the debit side and credit side, the balancing figure will be 240. So what does it mean? Our debtors have reduced. Debtors, these are people who have our money. And if they are reducing, if those people who have our money are reducing, if the figure is reducing, it is reducing because they are paying us. Money is coming in. So that 240 will be a plus 240. So it will be plusing 240 here because they are paying us. Then payables, you do the same. Payables, you do the same. You do the same for the payables. Payables, these are creditors. Creditors are our credit balance. The balance brought forward, you check from the statement of financial position. 2900. Balance carried down, that 200. Then when we disposed Salama Limited, additional information number 2, there were payables worth 320. And then when we acquired Rasaka, some payables worth 880. The balancing figure will be on the debit side, 260. So when payables or creditors are reduced, this is reducing because for payables, credit side is a plus, debit side is a minus, the opposite for assets. So these liabilities are reducing. When they are reducing because we are paying those liabilities and money is moving out. So 260 you minus. Okay, from there, so that's the working capital changes. And then lastly, you less the tax paid. The tax paid, how much tax? This tax tells us the actual tax which was paid. And you go to working number 7, the tax which was paid. You want to know how much tax was paid. Now you'll be combining your tax paid. You'll be tax paid with the liability figure. The balance pro forma, we have combined current tax and deferred tax. Opening balances for 20 plus 1440. The balance carried down, you'll be taking 600 plus 1600. When we acquired Razaka, there was a tax of 160, and in the income statement you find 900 there, and then the balancing figure will be 720 on the debit side. Now let me show you what I'm saying. You may not be getting where those figures are coming from, but what I'm saying is if you go to your statement of financial position provided, just look at non-current assets. If you look at the non-current assets, can you see current tax and also deferred tax? The opening balances are coming from 2018 and the closing balances are in the year 2019. So just combine deferred tax and current tax. You can see deferred tax there and current tax. You combine them together, you bring down the balance, one figure, and the balance carried down, you also bring down one figure. Deferred tax and current tax, we are combining them together. We are preparing one account for tax comprising of both deferred tax and current tax. That's what I'm saying. So if you look at the statement of financial position, the balances from the previous year and the balances in the current year, for current tax and deferred tax, you combine them together. You can see we have written somewhere on the credit side of that tax account, IS, that is income statement, 900. That is actually what you paid. That is actually what we paid, and it is in the income statement. The figure is 900. Look at the income statement. Look at where my figure is. Income tax expense, 900. Income tax expense of 900. We paid that figure. So that 900 is the one you see on the credit side. Then, I think when we acquired Razaka, there was a tax of, when we acquired Razaka, there was a tax of 160. Additional information number one, you can see tax payable. That information is relating with the acquisition of Razaka. Tax payable 160. So we acquired Razaka and there was tax of that particular figure there of 160. So finally, the balancing figure will be on the debit side. That is the balancing figure, 720. That is the tax paid. So our tax paid now goes on that side. So tax paid 720, that is how we have calculated that. And then interest paid or finance cost 114 is this figure which was here. This figure, finance cost, we had shown how this figure was arising. So it was misplaced, should not have been accounted for under that. So we are lessing it. After you less tax paid, you less 1/4 here. So net cash flow from operating activities is 4,440. So in other words, you are getting 44,610, and just for these figures, you plus, you minus, you get cash flow before changes in working capital 5,500. Working capital changes, you minus inventory 200, you plus trade receivables 240, you less payables 260, tax paid 720, less interest paid 140, you get 420. That is operating activities figure. The net cash flow from operating activities. Now you go to investing activities now. Disposal of PPE. I've shown you the PPE. When we dispose the PPE, the cash flow that we received 1100, but the net book value was 1000. The difference now is a profit or a gain, which was deducted here. The gain or disposal of PPE, but what we actually received when we disposed PPE, note number 4, we received 1100. Then disposal of subsidiary, working number 4. When we disposed the subsidiary, was that when we disposed the subsidiary, we received 44. I think we received 4,400 disposal of subsidiary. Is that the figure which we received? When we disposed the subsidiary, I think it was note number 4 or working number 4. Okay, disposal of subsidiary. How much did we receive? During the year, Makongeni Limited disposed of its entire figure. Okay, that's I've seen it there. When we disposed the subsidiary, we received 3,200. That 200 shillings is what we actually received. Disposal of subsidiary. Disposal of subsidiary. We record the actual figure. We record the actual figure that you receive. The actual figure which you receive. So you can check that. When you dispose the subsidiary, which subsidiary was that? Subsidiary which we disposed. Just check what is on the board. Disposal of subsidiary. Then the other item, so you can look at additional information number 2. That is where we disposed the subsidiary. We are told during the year, Makongeni Limited also disposed 60% ordinary shareholding in Salama Limited. The subsidiary had been acquired several years ago for a cash consideration of that figure. So that is where we received this particular amount. Just a minute. Now, disposal of substantially, you are putting that 200. I want to show how we are arriving at that. Should be working number 3. I think we're here. Refer to your working number 3. Refer to working number 3. And how you are getting that? You are taking that 400 minus 200. That 400 minus that 400 minus 200. That 400 minus 200. Just check your working number 3. Confirm your working number 3, which is helpful for you. You can look at your working number 3, how we are getting 34. The fair value of consideration. Refer to your working number 3. See how we got that 400. Fair value is our balancing figure. That working is also helping us because it is giving us gain or disposal of subsidiary. But when we disposed that subsidiary, how much did we receive? We received that 400. Look at our working. Fair value of consideration. How we calculated that. This 3400, why are we lessing 200? We are lessing 200 because when we acquiring that particular subsidiary, it has a cash and cash equivalence of 200. You can see cash and cash equivalence of 200 there. When we acquired that particular subsidiary, it has cash of 200. So we can receive the cash. We have to less it. So that that's 200 here. We are taking that 400 minus 200. Dividends from associates. Dividends from associates. Go to working number 6. Dividends from associates. Dividends from associates. Go to working number 6. Dividends from associates. You look at the investments. The balance brought forward have been given. Income statement. You see they paid them for 60. There is another amount coming from other comprehensive income, 200. Then the balance carried down. The balance brought forward and the balance carried down, you find them in the statement of financial position. The opening balance and the closing balances have been given. The balancing figure is 340. 340. So working number 6 gives you 340. Then PPE acquired. I don't move faster because the rest is simple. PPE, the account for PPE, you bring down the balances accordingly. That is working number 5. PPE. The balances are given in the statement of financial position. So look at the PPE, balance brought forward from the question, and the balance carried down. Those are given. When we acquired Razaka, there was PPE of 5120. It increases our value. Revaluation gain 800. You go to note number 4. We revalued some PPE. Then on the credit side, when we disposed the subsidiary, there were PPE amounting to 2900. Disposal, note number 4. We disposed an asset which earned carrying amount of 1000. Then there was depreciation of 1540, note number 4. The balancing figure is on the debit side, that 200. So if the balancing figure is on the debit side, it means our assets are increasing. So if our assets are increasing, our PPE is increasing, it's because we purchased more. So there was money out. Then acquisition of subsidiary. When we acquired the subsidiary, how much did we spend? We spent 5680 to acquire the subsidiary. Can you confirm that? Acquisition of subsidiary, you take 6,000 minus 320. 6,000 minus 6,000 minus 320. When we acquired the subsidiary, which subsidiary was that? Which subsidiary was that which we acquired? It's note number 1. The subsidiary which we acquired, we are taking the 6,000, because you are told this subsidiary which we acquired, how much money did you spend on that? You look at number 1, how much money did you spend there? Can you see 6,000 there? 6,000, purchase consideration of 6,000. During the year, Makongeni Limited acquired 80%. That information there. The 6,000 is what we spent, but why are we lessing 320? We are lessing 320 because that subsidiary which we are acquiring, they also have cash of, can you see cash and cash equivalents of 320? So we cannot acquire that cash in the subsidiary. We can only pay the difference. That is why we took 6,000. In acquiring the subsidiary, how much did we spend? How much money moved out? It is not 6,000 because that subsidiary that we are acquiring, they also have cash. So you less that cash there, and actually what we paid is 5680. So sum up that area, 1100 plus 3200 plus 340 minus 3200 minus 5680, you get 4240. Minus is a negative. Is net investing activities cash outflow 5240. Go to financing. Financing now, move very fast now. You look at loan borrowed. The loan borrowed, you have taken 1200 minus 200 minus what? Minus 2000. 2000. You go to your opening balances for the loans. You find that figure there. Go to the loans, the bank loans, the statement of financial position. How is our loans? Loans. Can you see bank loans? We opened with 1200. We closed with 2000. The bank loans. Okay. So it is money in because we opened that account. We opened the year with 1200. By the end of the year, we have loans worth 2000. So there is extra 800 coming in. The dividends paid to NCI. Now those figures have been given now. Dividends paid to NCI, we have 200. 200 is what we paid to NCI. And to the parent, so we paid 200 to NCI and 500 to the parent. That's man out in both cases. That's man out. The 200. The NCI, working number 8. Very fast, check. Working number 8. Working number 8, dividends paid to the NCI will be the balancing figure. Will be the balancing figure. Will be the balancing figure for the NCI. And then dividends paid to the parent. The dividends paid to the parent, you have seen that was 500. 500, that is given. What is paid to the NCI, we are able to see that. NCI, try to go through the question and See how I think everything is clear there. The dividends paid is a balancing figure. You are the one to fix it there. You are the one to fix it there. Okay, then what was paid to the parent is that? So for financing activities, there is 800 minus 200, you minus 500. Net financing cash inflow is 100. So the net changes in cash and cash equivalents, you take the cash flow from operating activities for 420, you plus, this was a minus, investing activities, the figure coming from investing activities, negative 4240, plus financing cash inflow from financing activities was a plus 100. So if you sum up the three, you get 280. That is 4420 minus 4240 plus 100, we get 280. So 280, you plus opening balance for the cash and cash equivalents. Opening balances for cash and cash equivalents is 5610 because it is. Let me just check that. Cash and cash equivalents, because again you are given short-term investments. Short-term investments. So the opening balances is 200 plus 360, and the other is 300 plus 5, 300 plus 540. No, check this. Just check the cash and cash equivalents opening balances. Can you see here? Cash and cash equivalents, because we are given short-term investments. Those are financial instruments which can be converted into cash within a short period of time. So you combine them together. So you'll be taking, for 2018, the cash now brought forward, coming from 2018 to 2019. You take 200 plus 360, which is 560. For 2019, you are getting 300 plus 540, and you get 840. So what you're doing is you are trying to finalize your question here. You have taken cash inflow from operating activities for 420. This was a minus 4240. For financing was a plus 100. You sum them together, you get 280. 280 plus 560, you get 840. And 840 is a balance carried out for the cash and cash equivalents. So you are able to reconcile that difference which was arising between 560 and 840. We have reconciled that. We are able to explain what brought about the difference between those two balances. So that is the end of our lesson for today. So we are able to prepare consolidated cash flow statement for group accounts. My number is there, plus 727871093. So that is 0727871093. That's my contact. So you need a textbook for advanced financial reporting. You call my number, I'll supply you with a book. Nice book for advanced financial reporting. Wherever you are, hard copy or soft copy, can send the book to you, and you can be able to understand more about our financial reporting, group accounts, and cash flow statements, including other essential areas covered in financial reporting or advanced financial reporting. So that is it for today. Remember to subscribe to the YouTube, like our videos, and you make the comments. And we will now, next lesson, because we are through with cash flow statements. We are through with IAS 7, International Accounting Standard number 7. We are through with that. We are able to prepare cash flow statements for group, whether using direct method or indirect method. So the next lesson now we will be taking the group accounts now, how to prepare consolidated statement of financial position as well as consolidated income statement, how to deal with hazard sheets, how to deal with subsidiaries, how to deal with joint ventures, how to account for foreign entities, piecemeal acquisitions and piecemeal disposals, and such other important areas which are covered in group accounts. For now, we have through with cash flow statements for group accounts, group, consolidated cash flow statements, and that is how we present them. So that is it for today. We can continue from there next lesson. So remember to subscribe.